Good afternoon, ladies and gentlemen. This is Robert Rayburn here at VLifePro Asset Management. I want to welcome everyone to our weekly market update. We have a lot to talk about. We know that the 800-pound gorilla in the room right now is the COVID Delta variant. It's certainly had an impact on portfolio performance over the last month. We've seen that the economically sensitive sectors of the market where we are overweight and focused on, because we do have a 1, 2, 3 year time horizon, have been hit over the short term. And we know that's caused some pain. And so we want to address, first of all, where we are in terms of the spread of this virus, but more importantly, as the virus starts to plateau and begin to decline, because it will, how do we want to be positioned as investors? Do we want to be positioned in companies that benefit from shutdowns, or do we want to position ourselves in companies that benefit when America flourishes? And so we're going to go through all of that today, and I'm going to go ahead and share my screen here. And what we can see here is that really the bottom line is that our theme is that we are in the second stage of America's great reopening, and that the COVID Delta variant, when we look back 6 months from now, we are very confident that we're going to see that the Delta variant was a speed bump, a pause in the great reopening trade, in the great reopening economic activity phase, if you want to call it that. In other words, it's not just about being a trade and stocks going up, but it's also about being the actual country reopening and thriving, regardless of the spread of this particular variant of COVID-19. And so the three big messages this week is that as the COVID Delta variant recedes, we're expecting a violent recovery in reopening investments. And fortunately for our clients and for our investors, we are very overweight the reopening. Why is that? Because we don't see a recession, we don't see shutdowns taking place, and what we do see is an incredible amount of pent-up value from companies that succeed when America succeeds. And so the big message is that the economic data continues to improve. The 10-year Treasury bond is dramatically overbought. In other words, yields are far too low relative to where the data is. And third, economically sensitive sectors and stocks are positioned for an explosive rally over the next 1 to 2 months. So what is that reopening playbook? Quite simply, if everything plays out as we expect the opportunity portfolio to rally rise between 20 and 25% plus over the next 3 months. Okay, Rob, that's great. But what actually needs to happen to make that a reality? Because of course, nothing is guaranteed. We could be wrong. But what needs to happen for this portfolio to increase 20 to 25% over the next, call it 2 to 3 months? First, economic data needs to continue to show progress. We're going to show some evidence today that it is indeed happening, but it needs to continue to happen in September, October, November, et cetera, and beyond. Second, COVID-19 cases need to plateau and decline. Certainly, if we are broadcasting in mid-September and cases are still accelerating upward and to the right, that is certainly going to be a big roadblock in terms of the recovery trade. Third, the 10-year Treasury yield needs to bottom, and we're seeing very substantial evidence that is indeed happening, and it's tied back to the first 2 points, and we're going to show how it all plays out. So where are we at today? So in terms of the state of the recovery, we've shown this chart many times, and there's a reason why. It's a very important chart. The COVID-19 recovery, in terms of the economic recovery, is extremely V-shaped. And in fact, it's the steepest recovery that we've experienced so far since the 1949 recovery. In other words, that post-World War II recovery. People got to remember, right after World War II, we actually had a bit of a dip because all that industrial activity from building tanks and airplanes fell off. Then we had the recovery, the real recovery, the baby boom recovery. This recovery is following that same path. I know it doesn't seem like it if we listen to the media or we read the newspaper, but that's actually the case. And we see that in the unemployment numbers, the spending numbers, all the numbers that we're going to go through today. Also, America's on the move. So one of the things that we look at here at LifePro is not just looking at backward data. Hey, here's what GDP did last quarter, or here's what the unemployment rate was last quarter. But what are the actual activity indicators that are updated either weekly or daily, or it could be sometimes 3 times a week or whatever it is. In other words, those high frequency data points, what are they saying about the economy? TSA passenger check-ins as of 2 days ago are at an all-time high post-COVID. In other words, after the shutdown, we see the big drop here as basically airports shut down in the US. Where are we at today? We're at a post-recovery high. In other words, yes, Delta variant has spread in the US, but it's not curtailing activity. And we see evidence of that not just in the activity levels, but in corporate results. Uber, Marriott, Lyft, what was the other, Live Nation. All of these companies are reporting an acceleration of activity. We're talking companies that are at the very center of the economic reopening. In other words, if it wasn't happening, you would be hearing it from them first. And they're saying July was their best month. But what's holding these shares back is that the fear, the blinding fear of the Delta variant is acting as an albatross or is acting as an anchor on these share prices. As that fear is lifted away, guess what happens to the share price? It's like holding a balloon underwater. As soon as you let go of it, it's going to violently rise to the surface. And that's what we expect with a lot of these share prices. Chart on the right, daily miles driven in the US, accelerating upward and to the right. Again, a hard sense of what is actually taking place when we strip out the impact of the media. Jobless claims, chart on the left, there are these initial claims falling downward and to the right. This is the one chart we want to see falling downward and to the right as opposed to upward and to the right. The continuing claims, same pattern. Now, we actually expect an acceleration of this over the next 4 to 6 weeks because California, Texas, New York, a lot of these bigger states, we're seeing those benefits end. In other words, those COVID era benefits that really gave an incentive for people to stay at home and stay unemployed versus go back to work. As those benefits come to an end, we should see a massive decline in jobless claims and also an acceleration in employment activity. But the question is, are the jobs there? And they absolutely are. If we look at the peak of the jobs boom in 2018 and 2019, this particular job openings boom is blowing it away. It's literally exploding upward and to the right. I can speak for our company when I say that we're actually having a lot of difficulty finding people to accept roles. It's hard to find people right now. There is a big labor shortage in the US. And what does that mean? That means higher wage prices, right? That means reflationary activity throughout the system and a more healthy US consumer. But more importantly, as people come off those government benefits, they're going to be looking for jobs, and the jobs are there waiting for them. So we got to get past the COVID-19 fear. So when we talk about that peak of August 14th, there's a few things that are going into those numbers. First, the Delta variant tends to spread much faster than previous strains, which also means that it peaks much faster, right? In other words, the faster you go through the population, it's like a wildfire. The more violent that wildfire is, the quicker it actually burns out because it runs out of brush to burn through. And so the same thing is happening with Delta variant. We know this from other countries such as the UK, Indonesia, India, that 45 to 50-day window of it spreading and then declining. Secondly, American mobility trends. If we maintain our mobility trends that have been in place over the last 3 to 6 months and project that forward, that gives us the August 14th date. Third, vaccination rates. We know that amongst the vaccinated community in the US, that it's much harder for that virus to spread. There are breakthrough cases and the vaccinated person can spread the virus, but it's much harder to. Secondly, amongst the unvaccinated community, it does spread faster. And secondly, you do see more flu-like symptoms amongst the unvaccinated portion of the population. Regardless, we had that 45 to 50-day window. All of these factors are suggestive of an approaching peak, whether it's August 14th, August 10th, August 20th, in that ballpark, we're seeing evidence of a forming delta peak. We see the evidence here in UK and India, 45 to 50 days for virus counts that bottomed and then ultimately accelerated with the introduction of the new strain, then bottomed out. 45 days for the UK as well, which is largely vaccinated at the same percentage of the population as the US. So that's a good indicator to use. Also, what are the percentage of positive tests amongst the population? So in other words, for every 100 tests of COVID, how many are coming back positive for COVID? We see here, whether it's Botswana, the UK, Netherlands, Tunisia, Denmark, South Africa, a wide sample size across the world, all of those countries are seeing big drops in terms of the positivity rates of their tests. Why? Because we merely went through the population and then started to decline in that 45 to 50 day window. Second, we're starting to see that 10-year yield capitulate. We saw panic buying of treasuries on August 4th. I think all of us remember yesterday, we had a bad day in the market yesterday, but the day before that, we had a really good day, and then we had a really good day today as well. So we're getting this pattern of 2 steps forward, 1 step back, 2 steps forward, 1 step back. We're about 7% off our lows from 2 weeks ago. All of this is suggestive that the market is starting to read through the headlines of COVID-19 and now starting to say, what does the world look like 2 weeks from now, 3 weeks from now? And we're starting to focus on, oh, hey, I actually want to own some of these very economically sensitive companies because those share prices, those companies have continued to make more money than they did 3 or 4 months ago when the share prices were 10, 20, 30% higher from where they're at today. So what we saw is on August 4th, panic buying and then a sudden reversal. Out of nowhere, a sudden reversal. We went from 1.12% all the way back north of 1.2. 8 basis point increase. That's a massive move for a 10-year treasury bond that should be not that volatile at all, especially intraday. So very suggestive of capitulation. So let's work through our playbook, ladies and gentlemen. So we know that the economy is getting better. We see it in the high frequency data. We know that corporate earnings are getting better. We have gone through most, I believe in the portfolio, every company is reported with the exception of 1 or 2. So we know things are better and they're making more money from 3 or 4 months ago. So we're in the reflation. So that generally means reflation versus deflation. Okay, what happens when we get a reflationary economy? 10-year yield goes up, not down. We saw evidence of that Wednesday, follow through action today. Let's see what happens with that non-farm payrolls on Friday. But I wouldn't be surprised if we continue to see a grind upward in that 10-year yield. So what does well when the 10-year yield goes up? In other words, reflation, inflation. Oil, banks, metals, industrials, consumer stocks all outperform tech, biotech, bonds, utilities, consumer staples, etc., when we are in a rising interest rate environment. And that is how our portfolio is positioned right now. On the other side, we want to avoid those crowded trades, whether we're talking, to our spouse or we're talking to our friends, our family, our neighbors. Everyone owns technology stocks. Everyone owns the NASDAQ. Everyone owns Google, Apple, Netflix, Amazon, Apple, Tesla. All of these large FANG names, everyone owns them. Everyone, right? And when you get flows that are this strong, we see it when the triple Q flows, in other words, those NASDAQ flows are in the 95th percentile and above, and we're beyond that, by the way, we want to go on the other side. We want to be sellers, not buyers. And same with treasury bonds. When everyone is 95th percentile flows into long-term treasury bonds, what do we want to do? We don't want to buy. We don't want to do what those 95th percentile people are doing. We want to be selling that. And if we're selling treasury bonds and yields are going up, go back to that playbook. What do we want to own? Economically sensitive stocks that do well when rates go up. In other words, oil, banks, industrials, consumer discretionary. Those are the types of areas that we want to own. Then, why, after 5 years, have we been such aggressive sellers of technology? I believe a picture says 1,000 words. And what we see here is the combined weight of financials and energy versus tech and healthcare could not be more extreme. What we see here is that Tech plus healthcare is back to 43% as a total percentage of global equities. When is the last time that happened, ladies and gentlemen? It was back during the dot-com bubble. Do you remember? Go back and watch our update from last week, 2 weeks ago, etc. What's the other thing that's happened since the dot-com bubble? Price to sales ratios right now for technology stocks, the valuation of those tech stocks is now beyond the dot-com bubble highs. In other words, tech stocks are now more expensive on a valuation basis than they were during the dot-com bubble era. Combine that with this picture, and you get a very dangerous picture as to where tech stocks are currently trading, including healthcare. We see it with shares of Pfizer, for example, recently. So what's the other side? Well, guess what? Energy and financials are near all-time lows, 18% versus that 20% low in 2000. What happened in 2000? Tech unwound for 10 years, it was dead money. And then we got the commodities boom. We got the financials boom. That one ended, of course, in 2008, but we had 8 years of financials outperforming, and then we had 12 years of commodities outperforming. We think something similar is playing out. That 1 month of underperformance you've seen in our portfolios, that 2 months of underperformance, that's just this little blip right here. We get this during leadership transitions, but the bigger move to pay attention to is this move right here, right? If this 18% goes to 36% and this 45% goes to 24%, don't get distracted by the last 2 weeks, the last 3 weeks. This is the important move. This is the difference between wealth and wealth destruction. We want to make sure that we're playing this side of the trade, not this side of the trade. And of course, we see that in the actual charts. Technology up 500, 600% over the last decade. Energy, financials, industrials, dead money. In fact, down over the last 10 years. So which has more upside, this chart or this chart? If you just look at the chart, honestly, it's that simple. So, that's how we want to stay focused on what's going to make money going forward, not what made money yesterday. So in summary, the economy is getting better. The 10-year yield has started to bottom and is moving upward and to the right. And of course, the one X factor is when COVID cases do plateau and decline, and they will at some point, those other 2 points are going to create a triumvirate of outperformance for those economically sensitive stocks. So we want to be positioned investments that are going to deliver outperformance, not over the next week or two, although that's great, but over the long run. We know that the economic recovery is powering through that Delta uncertainty. And of course, we want to invest in companies today that are going to outperform and prosper in a post-COVID fear world tomorrow. So that's what we have this week, ladies and gentlemen. Thank you again for all of your business, for all your questions, and for obviously all your patience through what's been a very choppy 2 months. But we're going in the right direction and we're recovering, and that recovery is accelerating. And so if anyone has any questions whatsoever, please feel free to reach out to your advisor, or you can reach out to us here at VLifePro at 888-543-3776, and have an absolutely fantastic, safe, and fun weekend. Thank you again, and have a great weekend.